Is there like a 30-second silver lining? Can we get some like nugget of hope?
Yeah, I mean, at the end of the day, consumer spending's going to be decent. It wasn't the world last year didn't end, and I'm telling you, it'll be better this year. So not much better, but still better. And if we're still doing okay right now, and everything was okay, that tells me okay, that's some positives. But I do again, it's always important to level set. I don't want us to get too excited about growth. But hey, I did say the words growth, and I want to leave everyone with that because that is important. We're not here to scare. Growth is growth.
Um, but hey, here we are at our April webinar. Thank you for joining us. So glad you're here as always. Today's conversation is one I've been looking forward to because let's be honest, when someone says economic outlook, right, it doesn't always scream must watch. But that's exactly why I'm excited about today's speakers. They are amazing. Seen them a couple times now, live and in person and on screen. Jeremy Bess, Patrick Luce, two economics who not only live and breathe data, but actually know how to make it meaningful, relevant, and even engaging. I know you guys don't believe me, but just wait and see. Jeremy is widely recognized as a thought leader in macroeconomics, helping organizations navigate what's ahead with clear data-driven insight, which is what we all strive for, right? He's known for turning complex trends into actionable strategies and for bringing energy to his presentation that keeps people off their phones and fully tuned in. I can agree to that. Patrick, just as dynamic, brings the same level of expertise with a unique ability to connect the dots. He has a real talent for taking complex economic data and shaping it into a clear, cohesive story that helps leaders like you make confident decisions in even these uncertain environments, right? We were just talking about like weird times. It's all weird times now. So I first had the chance to hear them at the Veterinary Hospital Practice Managers annual meeting last year, and then we were lucky enough to have them join us on the Veterinary Ledger podcast, which I'm sure all of you listen to, right? Um, Today will be a new topic so don't worry about repeats. Walking us through the current economic landscape as it's shaping the road ahead, 2026, what does that look like? Inflation, interest rates, consumer health and spending, what it means specifically for our industry, and where borrowing costs have a real impact in decision making. Oh, all of these things, all of these big ticket items. As always, the session is being recorded and we'll share it on our YouTube channel afterwards. So if you miss anything, we can always catch up later. Jeremy and Patrick are happy to answer questions at the end. So as they come to you, so you don't forget them, feel free to just drop those into the chat as we go. And with that, Jeremy and Patrick, thank you guys so much for being here. Please wow us with your knowledge.
Thank you for having us. And I like Pat's intro because when I hear it all, I tune it all out and then it ends with and Patrick's my work wife. Because that's what he is to me. Yes, he connects dots and does all those things, but he keeps me in check. It's an absolute pleasure, everyone, to present today. As Megan says, economics is. I mean, listen, it can come off as dry. Our job is to not make it dry, right? We want to make it tangible. We want to make it, not just a Wall Street Journal article. We want to really frame things out. Simply put, though, Pat and I spend a lot of our time in the macroeconomic space trying to say what's happening in the world actually can impact an individual. But really, we spend a lot of our time helping companies forecast their data and say, how does the macro actually impact what's going on in an individual business? So that's what we do. And boy, do we spend a lot of time in mathematical modeling. But we do our best when we can, if anyone's ever seen us present, to do a little mail modeling as well. So if you all thought that you weren't going to get a couple jokes throughout today's presentation, you'd be wrong because we like to have a little fun here. Again, make economics as fun as we possibly can. But jokes aside, why on earth should anyone be listening to us today? Because quite frankly, over the last year, I think economists have done a really bad job for themselves in the sense that they've come out with a lot of forecasts. Some of the economists that I've been reading for years have done a lot of forecasts, and many of them have not played out to what they thought. And I'm actually here to brag just for a minute, and this really does translate to why on earth you should be listening today. And it's because our forecasts are quite accurate, many of which we have not revised in quite some time. Actually, some of these have been in place not only for 15 months that you see on the right-hand side, but longer than that, and we haven't updated a few of them. So, for example, industrial production, 18 months. Consumer price index, we had today, if no one's paying attention, there was a release today, and you saw consumer price index or overall inflation rise a bit. Weirdly enough, we've been talking about that and saying that for over a year. We again have not revised that forecast. So on the left-hand side, just to calibrate for everyone, that black line that you see is consumer price index. The kind of the gray shaded region is a bunch of our different modeling telling us something in the past and in the future. But really, what we're in charge to do is to say where things are going in the future. And that's that kind of orange shaded region there. And you can see that the black line kind of is above or on top of that gray or that orange shaded region. And that's me showing you that we have actually not revised our forecast, and then that actually has just come through. I don't know if that's good or bad. It does say that we're pretty darn good at forecasting. Downside is, I'm sure you're seeing it. That would actually tell us that there's upside pressure on inflation over the next year or so. We can get ahead of that. There's things that we can do to kind of again get ahead. The whole point of today's presentation and is to say what you do with this information. I have no interest in saying, hey, all, here's inflation. That's it. Sorry, there's nothing you can do about it. We can do something about it. It's not that inflation is going to change by what we do, it's how we act. And as business leaders, there's things that we can do. It's not doom and gloom, everyone, right? We're actually talking about overall modest economic growth in 2026. Modest is the key word there. Does that mean certain industries are going to feel it worse than others? Sure. It's not hair on fire like the kind of the pandemic period, and it's not even that post Great Recession time frame. But nonetheless, I do want to say that 2026 is likely not to be the painful year. Even in your industry, we'll talk about it. I mean, we might be swimming, with the current a bit more, which is probably good because over the last couple of years, it's been a tough couple of years in the vet space. But again, I don't want us to be like, oh my gosh, we're talking about a lot of growth. It is going to be muted. But again, I frame this out because I still think there's a lot of pessimism out there in the world. But I will say, I'm not here to say it's all great. In 2027, where we are expecting decelerating growth, right? And that's where growth starts to get more muted. That's when we start to get a little bit more related to those inflationary periods. But we're going to feel some of that in the next year after that. But so if I'm just focusing in on 26, 27, right, there's things that we can do or we should do while we to get prepared. But unfortunately, inflation is likely to stick around, and that's so important, everyone, because if you look at your P&L, you look at your profitability in your business, cost is important. And we're going to frame a couple of those things out today. Patrick's going to give some interesting, things to think about. But again, when we're talking about inflation, I want you to think about it from a cost perspective. Before we do that, just want to calibrate on how we look at data because Pat and I are in the business of trending things out and plotting things on charts.
And a quick disclaimer, like charts are our love language. So when we say that there are going to be a lot of charts today, I promise it's not a threat. It's kind of like us, our terms of endearment here. But it's important for us to take a quick minute just to explain how to read them. That's what we're showing here. On the left is just annual year-over-year trends. What that does is it gives the shape to data, taking an annual moving average and trending it out on a year-over-year percentage change basis. Effectively, the economy does not move in straight lines. It moves in cycles. And what we see with client data is that that also extends to businesses as well. And what you do with those cycles and how you plan for the next cycles is key, right? We can be expanding where those cycles are growing at an accelerated pace or decelerating, still growth, but the turn has come, kind of like what you see in that orange line there, where it's above zero, but getting less zero. And then on the negative side, are we in contraction or in opportunity? Contractions when it's negative and getting more negative, contractions negative, but getting less negative. And by the way, if your planning can't handle a downturn, it's not a plan, it is a wish. If there's one thing that you get out of today, is that we want you to avoid planning linearly, planning based upon what has happened and not what's going to happen. Right. And so we can think about like a poster child for linear planning. If we look at CPI, for example, consumer price index, I know we're hitting y'all hard with the inflationary environment. I think it's been top of mind the past 5 years. But if we zoom out and say, well, gosh, inflation was not top of mind for the entire 2010s, right? You can see it humming along right around 2%. Everyone's fine and dandy and peachy. Yet a lot of businesses, a lot of organizations, a lot of households were caught by surprise when inflation started ramping up in 2021 and 2022 and 2023. And it's been top of mind ever since, right? CPI, as Jeremy mentioned, came in hot again this year. And all this is measuring consumer price index for all urban consumers. It's like our market basket of goods and services that we buy, and doing it on that percentage change from the year ago levels. So it's in that business cycle lens already. And when we see it hovering above 2%, we're above that kind of normal threshold that we were used to dealing with during the 2010s, right? Everything costs more. Nothing feels like a deal. Inflation is bad when you check your grocery receipt and it reads like a car payment. That's the environment that we're in again, and it's being suggested that that's going to persist. Jeremy and I are not seeing the leading indicators pointing towards further softening of prices. We're actually seeing several leading indicators that are suggesting more upward pressure. And one that really comes to mind is what's going on with supply chains. And so what Jeremy and I love to do when we do our charts, right? We're gonna talk about our love of charts. We love leading indicators. And so that's exactly what the orange line is talking about. It is the global supply chain pressure index. If you were to just go back to the fundamentals of economics and talk about supply and demand, if you have more supply chain pressures, that is going to put upward pressure on prices. And so that's what this orange line is measuring. But it doesn't happen all at once. Signals aren't transmitted immediately throughout the economy. They take time. And that's what we see with that supply chain pressure index. That orange line actually has about an 8-month lead to the consumer price index. And so it's pushed forward about 8 months into the future. So now we can get 8 months of forward outlooks as to what's going to happen with the consumer prices, right? Supply chain pressures have been on the rise. They're rising again. We're seeing shipping costs start to increase. We're seeing lead time stretch out, right? You shouldn't be ordering a pallet of optimism from your supplier because the delivery date will just say TBD. Here's the thing though. If you're tracking your input cost and your vendor times monthly, none of this catches you off guard, right? The people who are hurt are the ones still planning off of last year's quotes. Again, that idea of shifting the mindset from linear planning to future planning, looking at those forward-looking insights. And so this is one of those core indications that, yes, supply chain pressures, those are very structural, right? Jeremy and I can't predict what's going to happen with, say, geopolitical conflicts, but we can see those conflicts transmitted in the data like a supply chain pressure. And then what does that now signal for our prices? And the key here is we have 8 months to plan for that resumed rise. And while we're focused on supply chain pressures, again, as Jeremy mentioned, we might not be able to change the macroeconomic environment. We might not be able to change the geopolitical environment, but we can change how we plan for it. And so there's actually a really fun resource that Jeremy and I thought about for this exact conversation that comes from the FDA, right? That looks at specific animal drug shortages. So this is just going in and saying, hey, are we seeing if there's any specific types of pharmaceuticals that are fundamental in animal drugs and vaccines and things like that, right? It's the current and resolved animal drug shortage list from the FDI. And I'll shoot straight with you. Can I pronounce all the names on that list? Absolutely not. But this is a great resource for keeping a finger on the pulse, right? If supply chain pressures continue to mount and manifest over time, this is your forward look, right? Are we going to start experiencing shortages on vaccines as, say, an inventory start to deplete? And now with a bottled up supply chain network, do we have further and further pressure?
And
So when we go ahead,
I
Jeremy.
also I just think it's really interesting too, and just not to interrupt, but I think the point to be made here is this global supply chain pressure index has data through the end of March, which means it's capturing obviously what's been going on in the Middle East almost all of March. And I understand there's some changes going on this week, but I just want to reinforce this idea that that index has already been rising for quite some time. And so what's going on geopolitically hasn't changed our forecast because we were already considering well, global supply chain pressures, not this particular conflict. But again, the point there is there's been concerns around the world when it comes to supply chain. So it's really not been too much of a shock to us that this figure's getting kind of worse, right?
And it's not just supply chains, right? Again, Jeremy and I are tracking structural forces and what they mean for pricing outlooks. And so we can kind of highlight those structural forces. And again, just to reorient you on this graph, the chart on the right is showing supply consumer price indexes on that year-over-year basis. The black line is what has actually happened. The gray area, by the way, I know Jeremy showed our picture as male models. However, we are also econometric modelers as well. And the gray area is just all of our different models that are running. And then the orange area is us saying, hey, here is our actual forecast, right? We can't tell you that it'll be a range between 0 and 6%. That's helpful for no one. We need to dial in that forecast. And what it's telling us heading out into the future is to plan for more like 3.5 to 4% for consumers for 2026 and 2027. And why do we say that? We can talk about trade patterns. And as Jeremy mentioned, this consumer price index forecast has been in place for over 15 months. That's why the black line is actually into the orange area, because this forecast has been live. This is what we've been telling people for over a year now. And that's because we've seen a lot of structural trade patterns, right? If you zoom out and say, hey, 2025 was categorized by the T word tariffs and trade, our forecast actually took place before all of that structure or all those conversations and all the disruptions that happened in 2025 before the disruptions of 2026, because we can lean on these structural patterns, trade and national. This is not a new trend for the United States or even globally. Deglobalization has been happening for over a decade now. What that means is the intent to produce more locally, domestically, which helps shorten up supply chains, helps boost our domestic production, but also it's an expensive country to produce in. That's going to put upward pressure on prices. We can also think about what Jeremy mentioned is, while there's been a lot of doom and gloom signaled about the R word recession, we haven't seen it come. And that's also been part of Jeremy and my outlook, is that demand is continuing to showcase some resilience. Now, it's not hair on fire demand like we were talking about in 2021 or 2022, but muted levels of growth are still growth for the macro economy. Factoring in, again, going through this list of, again, we could chart you to death or just give you some highlights. Tight labor markets. That is a structural pattern that we're going to see persist throughout the remainder of this decade. So keep that in mind when you think about your labor force planning, your talent, the wages that you're going to have to pay folks. The marketplace is showcasing that wage pressures are putting upward pressure on overall prices. And then we can get even more structural and talk about the national debt and things like that. But gosh, we only have so much time. We can also talk about the positives as well. What's putting downward pressure on inflation? And that's innovation, technology, AI or hard innovations. And those are things that we can encourage folks to take advantage of. How do you abate some of these structural patterns in labor and deficit spending? Well, you take the advantage of more gains in productivity. And that's what we've seen in the 2020s, is the resumption of productivity gains that were really muted during the 2010s. So make sure you're staying in front of those productivity patterns, because that's how you abate a lot of these inflationary pressures. What can you do to make the folks that work with you, for you, more productive? And that's how you can get more output per every hour spent. And so we can think about, again, talking about inflation as a whole, but also we're here to talk to the industry, and so we can focus on what's going on in the veterinarian service sector. And so this is now plotting the veterinary services in orange against CPI, just the overall inflation environment. And generally speaking, there's some relationship here that suggests that the consumer price index leads by about 9 months. So you get some forward-looking signals from the consumer price index towards what your customers are paying, right? This is the same pressures that show up in your industry to folks that are seeking veterinary services. If you want to know the price pressures for vets and veterinary services, you look at a producer price index, which looks awfully similar to both of these charts here. Now, those same pressures showing up in the broader marketplace, showing up in your industry. And what that orange line is showing us is that you're looking at 6% year over year on customers seeking vet services, and that stings, right? And so the key here is how do we take all these pricing signals and make it into an action plan? And that's what we want to do is what does this mean for the folks on this call? What can you take away from today and start doing? Right. And if there's any chart or any slide that you take a screen capture is, I hope it's this one, right? Because these are the strategies that you can start deploying based upon the outlooks that Jeremy and I have for the macro economy and as those relate to the industry, making sure that you are looking at your data, put your profit and loss statements under a microscope. Margin pressure or margin protection is the priority because of those pressures. What is your cost per visit? What is your labor percent? What are the supply cost trends that are underpinning just that bottom line profitability, right? And making sure that you are understanding your data, avoiding the noise. If we talk about supply chain pressures, again, Jeremy and I have been tracking this over time and see that there is a lot of synchronization between geopolitical tension and inflation, and that means input cost risk. And so make sure that you're diversifying your vendor relationships. Make sure you're locking your prices in where possible, because the premise of buy low, sell high is so easy to say, but the question becomes is, well, when is the low and when is the high? Jeremy and I continue to see upward pressure on pricing. So the low is as soon as you can lock those contracts in, make sure that you aren't in place to see surges within your profitability or pressures on your profitability. And again, price with confidence. We have a lot of research into the consumer. The consumer is still able to service their debt. They are still seeing their disposable incomes grow. 2026 is a great window for fee schedule increases, but we are starting to get those signals from leading indicators like credit card delinquency rates, for instance, or global liquidity, for instance, that is suggesting that towards the end of this year, more specifically into 2027, the ability to raise prices are going to soften as the ability to access credit, as credit card delinquency rates start to put more and more pressure on the consumer into 2027. So again, if we think about trying to time our decisions, now is a great time to price with some of that confidence, because you might not have as much pricing power heading out towards the end of this year and into the following year.
Yeah, I think that's so important too, because pricing and in thinking about how to charge for services and or products, it becomes so reactive, right? It's like, hey, I finally got this cost, I have to pass it on, or I've increased, wages for my team, so I now need to pass that on. We're trying to tell you where wages are going, where inflation's going, so that we can act on it now. Because to be honest, the worst time to take price is when the consumer has been beaten up by inflation for a few years, starts to slow down their patterns, and then you start taking price. So just because inflation's doing something doesn't mean that's smart strategic pricing. Likely it's just a reaction. That's what businesses are doing. So all we're trying to do here is just get ahead of it. Right. And so when I start thinking about other inputs, not just overall inflation, when we start thinking about median earnings, a proxy for where wages are going. All we're doing here on the right-hand side is, again, plotting wages on a year-over-year basis. There's that kind of whiplash that you see during COVID. That's not that we were giving like deals on wages. That's a lot to do with just the basically folks that were out of a job, then entering the workforce again, then out of a job and entering the workforce again. But all I'm trying to do is see this general trend. If we focus in on 2011 to about 2019, it was somewhat muted, but you see this slow upward descent. What we're here to say is that upward descent on where it was heading is likely to stay. And so you can see our forecast here through 2026, expecting wage pressures to be around 4%. 2027, a little bit lower, but again, rounding up around 4%. That is above those 2010-like periods. And what I think is really important, though, is, if folks are saying, Jeremy, Pat, I'm doing wage increases 5, 6, 7% year over year. This doesn't reflect me. Well, all I'm trying to do is to say where the market has been. You might be tacking on an additional percentage or two. So if that's the case, you need to factor that into what I'm showing you. All I'm saying though is whatever you were doing in the 2010s, you'll likely be giving up wage increases in order to keep up, to be competitive, to maintain your staff, likely higher than what we were doing in those 2010s, right? And again, this is all also adding into why inflation is likely to be stickier pretty much for the next decade. Now, why is this important? Here we go. And I want to start directing this into why this is important for this industry. Well, one thing that comes to mind is if inflation is stickier or elevated beyond that 2% threshold that Patrick was talking about, right? We're going to have to start acting on that. And by the way, just as a quick call out, again, manage those labor costs proactively, try to be efficient where possible, right? So throughout today's presentation, we're giving these little nuggets, and Pat always says, pull out your phones, take those screenshots. But I guess it's recorded, so you can always circle back to it. But here we go. Federal funds rate. What the Federal Reserve, the folks that have kind of the ability to pull the lever on where interest rates are going, the Federal Reserve is going to be looking at where inflation is. Yes, they're looking at the labor market and it's somewhat softening. Maybe we'll start to see it pick up in the second half of this year. But inflation is definitely something they're keeping an eye on. And that's beyond just what's going on in the geopolitical environment. There's a lot of evidence to support why that inflation is likely to be more elevated than their expectations. And they don't like that. Right. And so on this chart, the black line is the federal funds rate. Just think of it as the interest rate environment. And you can see in 2022, you saw this big spike as they were reacting and trying to slow the economy down because had that hair on fire inflation during that time period. So they reacted to that. Those kind of gray squiggly lines that you see is just a reminder on what the Federal Reserve tells us versus what ends up happening a year or two later. They're not in the business of forecasting necessarily. They're in the business of managing expectations on where inflation's heading. And so if they tell us that over the next couple of years, they expect federal funds rate to slowly descend back to 3% or so, we're here to tell you that, well, they're not always what ends up happening is not always what they said was going to happen, or in fact, it might take even a few years beyond what they told us. Again, not to pick on them necessarily, they have a very difficult job. I'm just saying if you are focusing in on that, boy, they get it wrong. But why does this matter? Why does the federal funds rate matter? Well, it impacts us as consumers. It impacts credit card rates. It impacts things like mortgage rates, housing affordability, right? So what we're looking at here is that same black line, federal funds rate, comping it against the 30-year mortgage rate. Doing nothing crazy here, just looking at them but side by side. It's not going to be a one-for-one relationship. Banks can do what they kind of want to do. But boy, there's definitely this relationship as one increases, the other one generally increases. So why do I bring that up? Well, there is this inverse relationship between what goes on in the interest rate environment and how it impacts us in the industry in the vet world. So maybe I'll take this orange kind of line that you see and flip it upside down. Why am I doing that? Well, an increase in interest rates causes a decrease in spending. A decrease in interest rates causes an increase in spending. So that's what I mean by this inverse relationship. So what we're seeing here is, right, we saw that kind of big increase in interest rates in 2022 into 23. That's this downward spike that you see. And then since then, mortgage rates have cooled a little bit, and that's why you see it kind of trending upwards. Again, I flipped it upside down. Why do I care? Well, if I compare veterinarian and other services for pets and this is consumer spending, this is not inflation, this is actual consumption. If I look at this on a year-over-year basis, that's the black line. Again, lots of cycles here, but generally speaking, there is a very tight relationship between mortgage rates and your industry. Now, what I've done here, though, is taken mortgage rates and shifted them forward 2 years. Why did I do this? We do not see an immediate reaction to the interest rate environment to consumers. It takes time for us to slow our spending down or to increase our spending based off of what the Federal Reserve is doing and how banks are responding. It takes a while, 2 years. Well, that's good for the industry because it allows us to see where we are going in the next 2 years. And as a matter of fact, last year we were telling folks, hey, as we head into 2026, we're likely to experience some upside pressure. So that black line, by the way, is currently below the zero line. But you can see it's in what we call phase of opportunity, meaning it's negative, but getting less negative. We actually weren't expecting that low point to be until the quarter we're in right now, but that took place in September. So that low point is actually in September. So we've had 3 months of additional kind of I don't want to say growth, but cyclical rise. It's still below the zero line, but this is good, right? This is one I was saying earlier where I say I think we're swimming with the current rather than upstream. If I look at mortgage rates, what are they suggesting for the next year or two? Well, it's generally suggesting more of that upside pressure. It's not hair on fire growth. It may mean for an individual company no growth, but at least we're getting away from that year over year negative territory or what we call a recession or a contraction in the industry. I can almost care less about what Wall Street Journal says, about recessions. More about what we think on a year over year basis of contraction. So again, what am I talking about here? We're talking about things somewhat improving, but we need to be cognizant on really what that means, for the business. So kind of wrapping some of this up here. And we have good more slides to go through, but kind of bringing us, piece by piece. We talked about what that means for inflation and keeping your P&L under a microscope. We told you that wages are likely to be elevated, so plan for that, but also let's be more proactive and maybe more efficient with our labor. But I also just told you that, hey, we expect some growth. There's a trap that I see with companies that when they start to, get through that negative territory and they start to get, some year over year growth or maybe at flatness, they start to plan linearly, that Patrick was saying earlier, and they start to say, okay, got to start hiring again. We're seeing the doors open and we're seeing customers come in. This is great. And they overhire. And then what happens is, as things slow down, maybe in 27 and 2028, you have those really tough decisions to make, which, no one likes to do layoffs or anything. So you either have to do that or you eat it, meaning as owners, you make less money, less profitability. So I'm here to say that growth is coming, which is exciting, but not a ton of it. And so let's not overhire. Let's not overexpand. Let's make sure we are right sized for the growth that we expect. And again, what are we talking about though? Let's make sure that we're starting to gain some client retention, fill up those appointment rates because, as I mentioned, as we head out into 2027 and late into 2028, things are going to start tightening a little bit again, right? That's the ebbs and flows of the economy. That's what's happening. So when I think about acting now, build that loyalty now so that you're better insulated for when things do slow down inevitably. Again, more in that 2020, late 2027 into 2028.
I think Jeremy said we have quite a few more slides left. I think he meant to say we have about 100 slides left. So I hope everyone was having any plans for lunch.
That's not
Uh,
true.
I know. I'm just kidding because I'm trying to like manage expectations here because maybe we don't have 100 slides left, but I am asking you all to do homework. And so maybe I don't know what sounds worse, doing homework or doing 100 slides. The homework is, gosh, start looking at your numbers. Jeremy and I can come at this from a very macroeconomic level. We have to look at the 30,000-foot view and try and see where the economy is going. But you might not trend with the economy in the same way that a business might trend, or different segments flow with one another. So it's important to know your data, know your sales data, know your volumes data, And you can start to compare what those cycles look like, and maybe even start to compare what it looks like against other macroeconomic data series. Are there things that might lead? And so we did exactly that. We wanted to find a business in the industry that's publicly traded, so that means that we can get access to real data or actual sales data. And then we wanted to trend it against the veterinarian space. So when we do that, we found Freshpet. It's an American pet food company. They do cat food, dog food, marketed as fresh. It needs to be refrigerated. It's listed on the NASDAQ. So it has its own little ticker symbol. And the reason why Jeremy and I want to use that is it's a tangentially related publicly traded company to the pet industry. And so we wanted to just compare that to the data series that Jeremy was just showing, the real veterinary and other services for pets. Both of these are now on a year over year basis. And this is one of those series where you can see a lot more noise, bounciness in that orange line. But if you squint and you zoom out, you can see the same structural trends. Those bouncy peaks seem to ascend when the industry is ascending, and the bouncy troughs, the low point, seem to descend when the industry is descending. And so while we can say macroeconomic trends significantly impact individual companies, it's important for you to be trending your data to know, is there a lead time or a lag time, right? That services, the dashed black line, the real veterinary and other services for pets that we've been looking at, has about a 3-month lead. So if you're running Fresh Pet and you say, oh gosh, those year over year percentages continue to fall off, well, maybe we can think about what happens in the next 3 months. A low is generally being signaled from that macroeconomic indicator. So that market forecasting can actually help predict a company's revenues. Can you start trending yourselves against other macroeconomic series and knowing your own data? That is the homework, to know your own data. So if we kind of think about the action items here and kind of ideating on some measures that you should be tracking every single month, we wanted to flash this up. Another one, take your screen capture, take a picture with your phone, or if you go back to the recording, we're, gosh, what, 36 minutes in. So at the end of the day, here are things that we would think about if we were in your shoes to keep an eye on. Visits. Right? How do you measure your volume? Because you might have revenues that are growing, but if your visits are decreasing, that is something that gives you an early warning signal that real growth is actually turning negative. When we say real as economists, we mean adjusted for inflation. So if you're able to track your visits, plot it out on that year over year basis. Look for those cycles within your visits. That is your volumetric driver for your overall business. But then you want to think about, well, gosh, if we were to not just look at sales, but look at the average transaction charge. Are you capturing the full value of each visit, right? Your per value or per visit charge can also send signals. Is the consumer or your client starting to see their spending wane on each visit, right? Does that create some challenges there that you need to address? Do you also have to consider what the types of packages that you're offering from a pricing standpoint? Again, kind of going through each one of these: payroll as a share of revenue, inventory fill rates, what local client payment stress. There's so much noise out there, right? There's every headline is designed for clicks, but not clarity. So if you want more noise in your life, check out Jeremy at karaoke tonight. He is great with 90s, but he does take requests. But if you want more clarity in your planning, how do you pierce through that noise? You track your data, you measure it over time, and you start to see the patterns that headlines miss. And then you can still watch Jeremy do karaoke.
It's actually a site. I could do a "Don't Stop Me Now" by Queen pretty good, or at least I have stage presence. It's actually not good, but I bring the stage presence. I want to mention one thing on this slide too. It kind of popped into my head. Pat and I talk about this often, and I don't think I reinforced it enough. When we're talking about higher levels of inflation, we did relate it to cost and what it means for your P&L. But it also means that sales growth can happen, but it's driven by the idea of just overall pricing being higher. And so that real growth, that volume driven growth might not be there. And why that's so important is because you get this sales illusion is kind of what we refer to it as. And it's the idea that, oh my gosh, I grew my sales by 2 or 3% this year. I'm doing better than I did last year. That's great, except that's all driven by price. So your cost and your wages and so on and so forth are also increasing by a similar route. That means your profitability or your margins are actually negative or flat. And so that's what we say by that sales illusion. Sometimes looking at specific numbers isn't the heartbeat or pulse of your business. We think that volume metric is a better heartbeat of your business. It really lets you know, are you experiencing actual growth or just pricing driven growth, which is risky, right? You start to stake price, it puts strain on your clients and customers and so on and so forth. Over time, they start to leave, they start to look for others, and that's kind of how that works out. So again, that's what we mean by that, just to reinforce why we are talking about volume and as the heartbeat of your business. Last couple slides here, everyone. Maybe I'm just going to say, I'm going to jump on my soapbox for a second and say last year was upsetting to us. It was upsetting to us because there was so much noise around recession, 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 and we were presenting all last year trying to tell folks, no, that's not what's happening. Maybe specifically in the pet world, it was already happening, but the U.S. economy overall was actually experiencing some level of growth, and we ended last year with growth, and we've seen that in the broad measures like GDP and such. But why were we so confident? Pat and I look at this particular series under a microscope, and it's called industrial production. What the heck is that? Just think of it as manufacturing, as mining utilities involved in it, but generally speaking, manufacturing. So that black line is once again looking at manufacturing trends on a year-over-year level. And you can see that most of last year was actually above the zero line, meaning we were experiencing growth. And it would have taken a lot to see this thing kind of double dip back down. And actually, as a matter of fact, it didn't happen. It's only happened once in this data series. It goes back all the way to 1918. And it's only done that double dip once, and that was during the Great Depression. And we were sitting there last year saying, it doesn't feel like the Great Depression. There wasn't enough signals to tell us that. We were looking at leading indicators, and we were pretty confident. And now that we're saying, hey, we went experience last year, I don't hear those economists that were talking about recession, recession, recession redacting. If anything, they just kind of keep saying all these things, and then it becomes, well, what should you believe? And so you can see our forecast here still has a little bit more growth for the rest of the year, but we will peak and we will enter deceleration, right? We'll still be year over year positive, but getting less positive. And now you can see that orange shaded region as we head out in the next 2 years becomes a little bit more scary. Again, I'm not necessarily saying it's that big bite out of the chart like we see in 2008, 2009. I'm not scaring us. I'm trying to say, let's get prepared for muted and modest levels of growth. But yes, when we head into 27, we head into 28, you're going to see that media start to scream recession, recession, recession again, although it just feels like they're kind of always saying it. But I'm here to kind of just frame this out a little bit better. And by the way, if we look at consumer spending, which is retail sales, right? If we look at a proxy for it, and then this is kind of the measure that we look at. So it's retail trade, and it also adds in the restaurant space. So it's all really retail spending. You can see that we expect a little bit more levels of rise in that year over year growth. And then again, it's kind of plateauing. You can see this measure, generally speaking, doesn't cross the zero line. It actually has only done it once, and I believe that was in the Great Recession. It didn't even do it during the pandemic period. But I'm pointing this out because even on this chart, you can see like, all right, we're going to start dealing with a little bit slowing growth. And that's something to plan for. It's just I'm not seeing the full-blown evidence to say, oh gosh, it's a recession right now. I had a buddy of mine the other day say that. He said, I think we're in a recession right now. And I said, well, maybe by some academic definition of GDP, 2 consecutive quarters, we might see that. I don't know. We don't get that data for we get it on a delayed basis, but we get things like retail sales, we get production spending on a monthly basis. Not seeing that fall off a cliff, right? So we should have some comfort in saying, okay, over the next year, we can experience some upside pressure, a little bit of downside pressure in 2027, but not the end of the world here. So, framing some of this out, what's the bottom line? We've gone through a ton today on this webinar, but so let's just give some broad buckets, right? The first thing I want to mention is the industry trend itself is improving. We reached that low point in September on a cyclical basis, that year-over-year basis. As we get that cyclical rise, what did Pat say when you look at your individual company? It's likely meaning that you're going to have cyclical rise, right? We're seeing that in the publicly traded data because we can get access to it. We would likely see that company's going to have a bottoming out over the next quarter, maybe two, as it swings back around. Right, so we want to get prepared for that, and that's likely to deal with that upside pressure until 2028, where things are likely to be a little bit more of a concern. I'll say that. But again, more to come on that as we get leading insights into 2028.
And that's the industry. If we zoom back out to the macroeconomic environment, 2026, 2027, that is your window. We are still seeing that upward pressure on the consumer spending, just like Jeremy showed on that retail sales chart. The consumer spending is rising. What we need to account for, though, is that there are pricing and inflationary pressures in there. And so real consumer spending is rising right now. We see the potential for real consumer spending, meaning consumer spending adjusted for inflation, to have further pressure in 2027, where that might actually cause a little bit more of a pullback on a volumetric basis. So again, using this information, what can you do today? Start thinking about your pricing strategy, start thinking about your retention strategy, get that schedule filled up, get your new clients in, because what you need to do is figure out how you put this cohesive package together before the macro economy starts putting more headwinds in place. Like I said, late 2026, we see that peak. That's not the end of the growth, but it is the signal that growth is starting to cool off. Then we get into 2027, and then those signals transmitted into 2028. What can you do today to position yourself to win in the future? Not be planning linearly, not looking backwards, but win the future by planning for it now, today.
Yeah, and just that last piece again, kind of beating a dead horse there. The cost pressures are likely to stick around. Wages are sticky. The labor market, despite the headlines, yes, it's cooling, but generally speaking, we have headwinds, from a geographic perspective. We have an aging population that are not only did a lot of them retire during the pandemic period, but we're going to start to see a lot more retirement over the next 10 years or so, and that leaves a kind of a big pocket, a skills gap that's likely to kind of play out here. So how do you fix it, right? If wage pressures are a concern and we got people retiring and I can't find people to fill that space, well, now you're gonna have to do more with less, right? And that's kind of what we mean by lean into optimization as much as possible. I get it, everyone. AI is a very big talked about thing. And by the way, Pat and I, can talk about it all day as well. We find it to be generally speaking, a positive thing for the U.S. economy. But at the end of the day, if you can lean into technologies that can help save here or there, that is an investment that generally speaking has a bit less risk, right? And so what I mean by that is the ROI is likely to happen not only quicker, but long term, because we do see those geographic kind of pockets and headwinds as we head out into the next 10 years or so, that specifically speaking, the older generation retiring. So again, everyone gone through a lot. We do want to open it up for questions. Again, if you want to put in the chat, you can. I'm a big fan. If you want to unmute or ask it in that sense, I think we're allowed to do that. Maybe I'm wrong on that. But either way, ask questions as much as you can. And if you feel a little shy, no worries there. You see Pat's cell phone listed on the right-hand side there. Normally he does this to me, so I'm throwing it right back at him. Ignore the 570 number. That one's meh. But that 813 number, that's Pat's cell. Give him a call. Tonight's what, Friday? So give him a call tonight, really late, right when he puts his kids to sleep. He'll be great and love a nice late phone call. In addition, by the way, our linked emails, marketeconomics@stantec.com. And if you are curious, we have a blog that's that QR code there that links to our blog. We write on a monthly basis or so about a bunch of different things, right? Generally speaking, we try to make it topical. We try to be ahead of what's going on. As a matter of fact, we were talking about those geopolitical pressures in February. This is way before any of that Middle East conflict happened. And if you were reading that, you were already seeing upside pressure on those supply chain pressures. And again, we're talking about those things likely being worse. So I'll pause here. See if anyone has any questions. I think we have a few coming in, so it might take me a second just to read them out. But again, do want to thank everyone for joining on today's call. Pat, any of these you want to go first on one of these?
But you love this part. I'll wait for you to go first, and then I'll go second. I can be
Okay,
patient.
let's do one here. So I see the first one. I'm just going in order. If you're planning to open, words are hard. Words are hard. Here we go. Let's try that again. If you're planning to open a business in 2028, what can we do to plan for this? Well, it's a couple things I want to keep that in mind. Remember when I talked about interest rate environment? We were showing, hey, some downside pressure on mortgage rates and things, but not a ton, right? We're not going back to the 3% world of mortgage rates. As a matter of fact, all last year we were telling folks that if we got anywhere near the upper end of 5%, we would be incredibly fortunate. And as we headed out of 2025, they started to creep down a little bit. We got in February just below 6% by a few basis points. And then in the last 4 or 5 weeks, we've actually seen mortgage rates rise. That is us again reinforcing the idea that interest rates are likely to be elevated. Why? Because inflation's likely to be elevated and the Fed doesn't like that. So they're going to keep their rates somewhat elevated as well. Why do I bring that up? Well, if you're borrowing to open up a business, understand that that comes with more risk than maybe it used to. In addition, if you're opening in 2028, as a reminder, that is likely to be a year that we're swimming upstream. It's likely to be a tougher year. That does not mean, by the way, to not invest in that opportunity. If you're taking market share, entering an area that just doesn't have that opportunity or that needs the opportunity, i.e., you opening up that space, that's not a macro. That is an entrepreneurial decision. You can buck that trend. All I'm saying though is be aware, specifically if you're doing it on a financing perspective, because interest rates are likely to be elevated. So it might take a little bit longer to get that return on investment on a new on some new doors.
Piggybacking off the second question, any differentials seen between the GP and specialty markets? I'm assuming GP general practice. Here's the thing: we don't have, or we're not forecasting disparities between general practice or specialty markets. I know VHMA does a lot of dashboarding work to kind of delineate different service offerings. But again, when we kind of keep it at that macroeconomic lens, we can break it down perhaps and see if they proxy or compare similarly to more consumer staples versus luxury goods. And so when we zoom out and talk about consumer staples versus luxury goods, we can talk about the food environment, we can talk about the spending on healthcare, and those things tend to hum along and tend to be a bit more resilient to economic downturns. Great leading indicators for those economic downturns or upswings are spending on luxury items like jewelry and boats, and that space has been a bit weaker as of the past year or so. We've seen it pick up a smidge here, but luxury goods, luxury items, specialty markets tend to feel those macroeconomic pressures first as consumers start to cut their spending. We're seeing a rise in consumer delinquency rates. And again, where those cuts will come are typically more into those specialties places. But a great way to smooth out your business cycles within your own practices is to diversify. How do you abate some of those pressures if you are in the specialty markets? Well, you start to look to more of those consumer staples, for vet visits, for just general treatments. And so at the end of the day, it's about trying to steer that balance appropriately. As I mentioned, we will see those luxury markets or more specialty markets react more quickly to macroeconomic headwinds, such as global liquidity starting to slow down, such as mortgage rate environment. If we see an uptick in the mortgage rate pressures leading out into like 27, 28, as inflation continues to mount, those will all put downward pressure on those specialty markets first.
My turn. Gosh, man, just hogging it. couldn't help myself. Real quick, so someone asked a question on the first question that was answered about, well, what if we open in the next 2 months? And just real quick on that, I would actually say from a timing perspective, it's probably decent, right? Because the market just bottomed out around September on a again on a real basis, meaning adjusted for inflation. And so if we expect a little bit more upside, that's a decent time to open up. Whereas if you opened up, let's say last year or the previous year when it was entering that cyclical decline, contraction on a year over year basis, that probably would have been a tough time to open up. So in the next 2 months, listen, it's not timing it out perfectly, and the business plans need to be put in place properly. But I would say at least now we should start to experience a little upside pressure, which is positive. So a decent time there. Real quick here, I'm looking for a regional CPI or PPI data, specifically Boston, the Boston area. Any good sources? So for everyone, a couple notes there. CPI is the Consumer Price Index. PPI, really interesting kind of nuance. That's Producer Price Index. So it's the cost of creating a finished good or an intermediate good. All right, there's some for like needles, for example, right? That would go into shots. That would be a producer price index, for example. But just as a heads up, Boston is actually a good one to talk about because the Bureau of Labor Statistics, which is the one that produces that, uh, releases certain MSA, so metropolitan areas. Not every city or every or every town in the U.S. has its own CPI or PPI, but the Boston area does. So it's the Boston, Cambridge, Newton CPI, and that is the MSA area. So that gets you a little bit more granular. But mark my words, and we do this often. What happens in the macro impacts the market areas or impacts the micro as well. So you will see a very tight correlation between overall CPI in the US that we went over today and that Boston, Cambridge, Newton.
Thoughts on Chewy's acquisition of Modern Animal. So I think this is a core trend in the industry. I think so many industries, as we talk about private equity or large mergers. I saw a statistic. It was like 40% of veterinary services by revenue held by corporate chains. I think what this offers is obviously a lot more visibility into those mergers, those bigger companies that have the advertising budgets. If we were to think about it as a small practice, gosh, is this an opportunity to try and showcase your level of service? More being that neighborhood kind of veterinary service. How do you compete with those folks? It is going to be on quality of care. It's going to be on understanding and knowing your customers and clientele, making sure that you're being proactive with reach out. It is that level of service differential that you might not get from a big corporate entity. And so how do you beat them is by trumpeting your comparative advantages.
I think,
Uh,
if I'm not mistaken, Megan, we hit the top of the hour here. And we're likely hitting up against lunchtime. But I just wanted to say thank you everyone for the questions and for joining. Our email address once again is marketeconomics@stantec.com. So if we missed any of your questions, please shoot us an email and don't hesitate. We'll likely have again our love language. We'll likely send back a response in slide form.
I would love before we all leave, is there like a 30-second silver lining? Can we get some like nugget of hope?
Yeah, I mean, at the end of the day, consumer spending's going to be decent. It wasn't the world last year didn't end, and I'm telling you, it'll be better this year. So not much better, but still better. And if we're still doing okay right now, and everything was okay, that tells me okay, that's some positives. But I do again, it's always important to level set. I don't want us to get too excited about growth, but hey, I did say the words growth, and I want to leave everyone with that because that is important. We're not here to scare. Growth is growth.
Okay, so don't buy a boat, but do plan ahead.
I mean, if you want to buy a boat, fine, but I want to go on it with you.
And karaoke, bring your karaoke machine. You guys have been great. This is always like an overwhelming amount of information, but I think that like there's lots of wheels spinning. So I hope that everyone came away with some great takeaways. Sorry, there's a thunderstorm and my dog is anxious. Um, But you guys are always on point. I love that it's vet med specific instead of like the huge, impact of the general economy. So I think that there's probably some more questions coming your way. Appreciate your time. We've got a webinar next month on front training of front desk staff. I don't know. It's a big swing from economics to that, but it'll be great too. Um, Patrick, Jeremy, thank you guys. Appreciate you as always.
Thank you.
Thank you.
Thank
Bye-bye.
you all.
Bye, everyone.